Recently on my blog, I promoted an old video that talked about a balance sheet problem for business sellers and got an email back from one of you talking about how the same issue had created a problem for them after they had bought the business. Stay tuned. We're going to be talking about balance sheet bombs and how you can look for them and avoid them.
I'm David C. Barnett, and you're tuned in to Small Business and Deal Making, the podcast, YouTube channel, and blog where I talk about buying, selling, financing, and managing small and medium sized businesses while controlling risk. So, if you're looking to take control of your future through buying a business one day, or if you already own a business and you're looking to grow or exit, you've come to the right place. I talk about interesting things, I talk to interesting people, and I answer your questions every week right here. So, be sure to hit like and be sure to hit subscribe, and let's get to it. Are you thinking of growing your business or beginning a journey into entrepreneurship? Take a shortcut to success by buying an existing and profitable business the right way. Visit businessbuyeradvantage.com and learn more about my online training, group coaching, and consulting services designed to help you win.
So every Saturday on my blog, I put a new article or piece of content that we've created that is largely based upon a video that's one of my older videos because, I just celebrated 11 years being on YouTube. And so I've got a ton of content out there, and I sometimes get emails from people who say that they've watched all my videos going all the way back. But I know that there are people out there who have not, or who may have, but it's been a long time since they last saw some of the videos from like '04, '05, '06, uh, or I guess not quite that old, but from 11 years ago. So this email that I put out promoting the blog post, let me share it with you here. It says, are your books in order? And this is from May 17th, 2025. It says, are your books in order? Are you sure? Many small business owners don't actually look at them and ask themselves if they are correct. This week, we revisit a story in which a small business owner got a lot less on closing day than they thought because their books were not being kept correctly. And it was an easy fix that they just never chose to do. Check it out on the blog post over at David C. Barnett, and then it relates to a video. And I'll link to this video down here, and we'll also put a link here in the video. Um, and that's what the cover looks like. So this is a little snip image I took from the blog post where it's me looking at a whiteboard, talking about a balance sheet and talking about a problem. So I got a response back from one of you who, by the name of Tim, and I've removed his full identity here, but he says, as always, excellent video. I recently, 3 months ago, purchased a business where I came to find the seller had been doing this exact same thing. However, because it was a stock purchase, those liabilities remain with me. Woo! Okay. So this person bought a business, thought they understood what liabilities were being transferred over to them, but because the balance sheet was inaccurate, guess what? They owe more to suppliers than what was revealed in the actual balance sheet they looked at to do due diligence. He continues and says, I am in the process of requesting supplier statements to learn the full dollar extent while carefully documenting all findings. Lastly, I'll need to sit down with the seller and seek some monies back. Fortunately, there's a large note and I lease the building from the seller, so I may prefer to discount the rent until covered. So Tim protected himself in this transaction against what? Again, I always talk about this. You need a seller note of material size to protect yourself from undisclosed or undeclared liabilities, any kind of material misrepresentation. And finding out that tens or hundreds of thousands of dollars are owed after you bought a business and now you're responsible for that money, that is definitely a material misrepresentation because you were shown a balance sheet that said here's the liabilities and it turns out that that was false, right? This is why you need a materially sized seller note. 5-10% seller note does not cut it in my books ever, ever, ever. Learn more about that by signing yourself up for my buyer course over businessbuyeradvantage.com. Like, don't get stuck in a situation that ends up being a nightmare story that that other people have to learn from. All right, let's get back to this. He says you did not include in the video, but if this accounting practice led to an artificially higher profitability, it would have affected the valuation of the business, which is a great point. Okay, we're going to talk about that. And then he says, the challenge in proving this is that I only learned of the practice with 2025 invoices and learned that the seller did this to prop the profitability of them up by monthly or yearly. In fact, he taught me this trick to make the business look more profitable than it was. My due diligence was using the 2022 to 24 financials. So proving with exact examples of this practice via invoices is impossible as the evidence is gone. Any thoughts? So let's be clear about what exactly we are talking about here. So what we're talking about is we're talking about a business that receives an invoice. So think about the telephone company. Okay. Telephone company sends you an invoice on a certain day and it says you owe them $100. Now, the due date might be a month from now. The proper accounting practice is to take that invoice, put it into your accounting software as money that you owe, but is not paid. And this then appears on the balance sheet as an accounts payable, showing that you owe the money. Okay. When you pay the bill, then what happens is money leaves your bank account, goes to the telephone company, and the payable disappears as the cash balance goes down by the same amount. Okay. So that's the way it's supposed to be. And in doing it in this way, by looking at the balance sheet, we know at any given moment in time how much we owe to our suppliers. Now, what was happening in the situation that Tim described? Well, what was happening was bills would arrive and they were not put into the accounting system. So the accounting system did not show that there was an amount payable. That means the payables on the balance sheet were less than what they really were in real life. And so Tim bought the business as a share sale, meaning he was acquiring all the outstanding liabilities and receivables or what have you at the time of the transaction. And it was not properly disclosed to him what the actual payables were. It was lower than it should have been. So let's go through the assertions that are in this email. First of all, number one assertion is that by doing this, by delaying when you enter it into the system until the time you pay it, it artificially increases profitability. Well, how would it artificially increase profitability? So if you receive a phone bill, for example, in December and it's due in January, by recording it as an expense in December, you are going to reduce the profitability for that year. If you ignore it in December and instead record it as an expense in January when you pay the bill, what you've done is you've moved the expense from one accounting period to another. And so it makes the first accounting period appear to be more profitable because an expense is missing. And so this is what is meant by it makes the business look more profitable. Okay. So Tim is obviously worried that what has happened is that this, error has caused the business to be overvalued. Now, I have good news for Tim. There's good news and bad news. So the good news is that if the business owner in fact did start this behavior many, many years ago and has been consistently doing it, what has happened is that in the first period in which they started to do this behavior, they would have moved some of their expenses to the next period. And so in that first period, and it sounds like it could have been years ago, that year would have had an inflated profitability. But once those bills had been moved into the next period, if you just kept moving bills into the further period, what ends up happening is that you don't really gain any additional advantage. Okay. Because any expenses from December get moved into January, and then at the end of that year, December expenses get moved into the next year. So once the benefit's been achieved the first time, it really doesn't compound or anything unless the business is growing year after year. And then there is some degree of additional benefit as the growth of the expenses grow. Okay. And to Tim's uh, point here, how would you be able to prove it? You would actually have to rebuild the accounting for all those years. You would have to go and look at the invoices and then match them to the transactions in the system. And you would have to specifically look for December invoices that don't appear in December in the bookkeeping, but rather appear in January or whenever the fiscal year end happens to be here. But I'm just going to assume the calendar year. So it could be done, it could be calculated. You would actually have to look at the invoices one at a time. You'd have to compare them with the accounting entries, and you would be able to undo that. There's a term for an accounting investigation into a business that you're going to buy called quality of earnings. And so, in a quality of earnings, this is the kind of thing that they will sometimes look into. In fact, back, oh geez, I didn't note a few years ago, I had a live stream guest, Elliot Holland from Guardian Due Diligence. And one of the things that Elliot said, and I'll put a link to that interview in the notes down below, is that in every Q of E that he does, he finds some degree of mixing between cash and accrual accounting. So, just as a recap, what is accrual accounting? Accrual accounting is matching revenue and expenses to the period in which they occurred. So in our example of the telephone bill, if we got the phone bill in December for a service that had been rendered in that calendar year for like the end of November, early December, we want to record the expense in December because it matches when we actually incurred the expense. That's accrual accounting. If we record it in our financial software when we pay the bill, that is cash accounting. So some businesses will use cash accounting. They will record revenue when it arrives and you deposit the check. They will record expenses when they are paid. And as you can see from that example, if everything is cash, then you get an idea of what's happening in the business one year after the next. If everything is accrual, you get a much clearer picture of what's happening one year or the next. And accrual accounting is by far way more accurate and better for making decisions and having information about a business to really know what's going on and to be able to truly understand what's happening from one year to the next. An example I always like to give is if you were involved in some kind of construction, for example, and you built something for somebody, and then there was some kind of dispute. As the contractor, you would probably end up paying for all the materials and paying for all of your employees, your labor. And if you paid for all of that, and then the customer ultimately did pay you, but it was in the next accounting period, then it would make one accounting period look way less profitable because all the expenses from a project were there. And then in the next accounting period, you look way more profitable because the revenue from that project would be in the next accounting period. And it would just skew things like crazy. And in construction is one that I like to point out because you've got small contractors who might do a relatively low number of high value projects in the run of a year. And so if this kind of thing happens, it can totally throw off the financial statements and you can start to get this really choppy performance over time. And whenever I'm looking at one of these businesses with one of my clients as a buyer, and they say, this thing's all over the place. We really don't know what's going on here. The very first thing I'll ask is, are they cash or accrual based financial statements? And they're almost always cash. And it belies this problem of matching. So what then should Tim do? If there hasn't been a lot of growth one year to the next, then ultimately the losses that Tim faces, the additional liabilities that were not disclosed, are going to be limited to the amount of liabilities he discovers in the current year. If there's been growth year over year in this business and the amount of this trick has been compounding one year after the next, then yes, the profitability of the business could have been inflated. Now, what is interesting is that the seller of the business showed Tim the trick, meaning that the seller of the business is not really fully informed as to what they're doing. Because what they basically signaled to Tim is that they've been messing with their financial statements and that Tim could, in fact, be their victim of fraud. So the business owner uh, has, for whatever reason, been trying to demonstrate more profitability, which is not common because usually what's happening is business owners try to manipulate stuff to reduce profitability. So, what I have actually seen more often than not is people do this kind of thing in the other way, where they will try to put revenues into the next period while keeping expenses because they want to reduce their profitability because they're trying to manage their taxes. If you've ever heard the term sandbagging, I first heard it when I was in sales, where if you have a certain monthly target, for example, or quarterly target, and you hit your target, and then you got another customer that wants to buy from you, you have a choice. You either say, okay, if I process the sale right now, I'm going to blow my target out of the water and do way, way better. Or if I can get this deal to be signed in the next period. So if you're at like the 25th of the month, you say to the customer, oh, I'll swing by on the first and we'll sign this up. And what you're doing is you are moving that result from the current period, month or quarter, into the next one to give yourself a leg up on the next period, right? That's sandbagging. It's basically moving stuff into the future. And that's what I more commonly see in the world of small business is that people are trying to manage their tax bill. Rarely are people trying to push the limits of profitability unless they've been actively preparing for perhaps the sale of their business and they're trying to make it look as good as they can. And so again, in the world of small business, you can investigate this stuff. You can hire people to do quality of earnings investigations. You can have all kinds of stuff like this happen, but at the end of the day, as a buyer, you never 100% know a business as well as the seller does. The sellers have years of experience. They've been running the business for years. They know everything about the business. They know everything about how it's being operated. The risk delta, the information delta is enormous. And this is why I always advise my buyers, you've got to have a material amount of seller financing in place to protect yourself against these unknown kinds of things. And when I talk to my sellers who say we don't want to do any seller financing, et cetera, I draw their attention to these kinds of things that they don't see the risk because they understand everything there is to know about the business. The buyer does see the risk. And when sellers say, I'm not going to do seller financing, what you're basically doing is you're raising a flag to buyers to say, I don't want to be responsible for what you might find later. And that puts the buyer on a completely different footing where they now have to be in a position where they need to find everything that could be wrong during due diligence or factor in some kind of allowance for this unknown risk into the price or deal they agree to, which means ultimately as a seller, you're probably not going to get as high a price as you could as if you approach this from the point of view of, I am trustworthy, you can count on what I'm saying, I believe in you, and to demonstrate my commitment to this deal, I'm going to be willing to finance a material amount of this deal because I want to see it happen and I want to be a facilitative partner in this transaction, which makes the buyer feel warm and fuzzy and know that they've got the security and guarantee of that offset clause, which, as we've learned from this very case, Tim's going to end up having to put into play. He's going to have to go and meet with this seller and talk with them about these unforeseen liabilities. It's literally money out of Tim's pocket that he didn't plan on having to spend. And it was never clearly demonstrated to him before the deal closed. So in my mind, it's like a open and shut case where the seller has misrepresented and probably needs to make some kind of post-closing adjustment to Tim, either with respect to the seller note or the rent, as he points out. Anyway, I want to thank Tim for sending in that comment, and I want to thank all of you for your participation in leaving comments and stuff in this channel. It's how I get the ideas for these videos every week. Any new viewers, I've been making these videos for 11 years. There's lots to see. Dig into the content of the channel. And if you are somebody who wants to talk about selling their business, head over to howtosellmyownbusiness.com. We have a whole suite of services that we offer to people who own a business that may want to exit and don't want to have to pay a high business broker commission. So we actually have a process where we can help you sell your business without a high commission. And I would welcome you reaching out to us on that website after you check out the videos there and learn more about that. And with that, I'll say thank you very much, and we'll see you all next time. Cheers.
So, how can you learn more about buying, selling, financing, and managing small and medium sized businesses? Easy. Go over to my blog site, davidcbarnett.com, where you can learn more about me and how I work with my clients. You can learn more about my books and courses that I prepared for you. You can find out how to subscribe to my email list, the YouTube playlists, and more. There's literally hundreds of hours of content there, all for free, and I'd love for you to be my guest. Special thanks go to Mark Willis at Lake Growth Financial, today's video sponsor. Mark helps people better manage their personal and business finances through the Bank on Yourself insurance strategy. This is something I've done personally and I've seen others use it successfully for years. Go to newbankingsolution.com to find all the interviews I've done with Mark and learn more about the advantages of these programs. While there, sign up for a free consultation to learn what this solution might look like for you.